100-year-old company doesn't just disappear. It doesn't wake up one morning and decide to die. And yet, over the past 2 decades, some of the most iconic American brands, names that survived wars, recessions, and cultural revolutions, have quietly vanished. Not because people stopped buying, but because of how they were owned. Here's the uncomfortable part. Many of these companies weren't killed by competition. They were engineered to fail. And the tool used to do it is called private equity. Now, on paper, private equity sounds almost heroic. Investors pool massive amounts of money, buy struggling companies, fix them, and sell them for a profit. Efficient. Ruthless, maybe, but effective. That's the story. The reality is more complicated. Let's walk through the mechanics. Step 1. A private equity firm buys a company. But here's the twist. They don't use their own money. Instead, they load the company itself with debt to finance the purchase. So the company buys itself. Imagine taking out a huge loan in your name, handing the cash to someone else, and then being responsible for paying it back. That's a leveraged buyout. And from day one, the clock starts ticking. Because now the company, maybe a retail chain, a restaurant brand, a manufacturer, is drowning in interest payments, millions, sometimes billions. So what happens next? Cuts, layoffs, store closures, cheaper materials, deferred maintenance, anything to generate cash. On the surface, profits might even improve. Margins look better. The numbers clean up nicely for a few years. Long enough, at least, for the private equity firm to extract value. And this is where it gets interesting. They don't just wait for a sale. They often pay themselves dividends, using more borrowed money, again loaded onto the company. So the business takes on even more debt to pay its owners. It's legal, it's common, and it's incredibly effective for the investors. But for the company, it's like running a marathon with a backpack full of bricks that keeps getting heavier. Eventually, something breaks. Maybe sales dip slightly. Maybe the economy turns. Maybe a competitor gets sharper. Under normal conditions, a healthy company could adapt. But a debt-loaded company doesn't have that luxury. One bad year becomes catastrophic. And suddenly you see headlines: bankruptcy, liquidation, another failing brand gone. Except, was it really failing? Or was it suffocated? Here's the irony. Some of these companies were still loved, still profitable at their core, still relevant. But the financial structure wrapped around them turned them fragile. Private equity didn't always destroy them overnight. It just made survival mathematically harder. And in finance, math always wins. To be clear, this isn't every private equity deal. Some firms genuinely rebuild companies. Some create real value. But the pattern is hard to ignore. Short-term extraction over long-term stability. Financial engineering over operational health. And the incentives are perfectly aligned for it. If the company thrives, investors win. If it collapses after they've already taken their returns, they still win. The risk doesn't disappear. It just gets transferred onto employees, customers, and the brand itself. So when another familiar name disappears from the market, it's worth asking a different question. Not, why did this company fail? But who benefited while it was failing? Because the next time a beloved brand is quietly hollowed out, it might not be a story about decline. It might be a story about design. And the real question is, how many more are already on that path right now?